we're on to the panel, and I would like to welcome you all and introduce you to Sam Smith, who's the CEO of finnCap, who's going to chair the panel, and then I think everybody will introduce themselves. So over to you, Sam.
Thank you, Tim. Very warm welcome to the last panel session of today. Good that lots of people are still around on a very hot, sunny day. Thank you very much for our three panellists for joining us. We've got Judith, Mackenzie, Leigh, Himsworth, and Dan Nickols. All have got probably 15 plus years experience in the small cap investment world. So it would be good to get their experiences today. I think from my point of view, we act for probably 120 corporate clients. We're the largest broker on AIM. And this is probably one of the biggest issues I think we come across, is trying to get companies to present in the right way. And it does make a huge difference. I don't think it can be stressed really strongly enough how important it is. It can make the difference between whether you will get a fundraising away or not, or at what price. It can make the difference between getting a new investor on board or not, and it can really impact your rating. So from our point of view, it is really important. I think between the three of you, you've probably seen hundreds of companies, so we should be able to get the benefit of your experience today. So I'm going to ask everyone in turn to introduce themselves, give us a bit of an overview of what they're looking for and what their sort of investment criteria are, and some key attributes they're looking for the companies they see. So should we start with you, Dan?
Sure, okay. Thanks, Sam, and hello everyone. My name is Dan Nickols. I'm head of UK mid and small cap at Old Mutual Global Investors. Putting that into context, in the mid and small cap space, we run around 3.25 billion, and I think that probably puts us a little bit further up the market cap spectrum than some of the practitioners in the space. So we would look at companies, so we think about the smallest company in my portfolio is probably around 30 million. Typically, we're somewhat further up the spectrum, even in the small cap funds. So I think our average market cap is probably around 500 million. But we would look at everything up to the very bottom of the FTSE 100. So it's a very broad remit. If we try and distill things to their essence, when we're asking ourselves the question, where does our return come from? We're, I think, looking for three key criteria. So we're looking for companies which we think can deliver above average earnings growth on a sustained basis, 3 to 5 years, often for, often because they have some sort of secular driver behind them. So they have some novel product or service, or they're addressing some specific market niche which will enable them to deliver that very visible earnings growth over that sort of time period. We're also looking for companies which we think can surprise the market positively. And to that end, we spend a lot of time meeting with company management teams, trying to understand the trends that they are going to benefit from, and combine that sort of work with understanding where consensus views and forecasts are, and essentially sort of betting against them when we think they're wrong. And then finally, we're looking for companies that we think can be re-rated relative to the market, and that's very often because there is a specific catalyst that's likely to unfold. So that can be something like the injection of a new management team, a new strategic direction for a business, perhaps a new sort of capital structure, something that's more appropriate, more sustainable. So those really are the sort of three key things that we're looking for. If we think about, what we want from companies, what enables us to actually sort of feel confidence to the point of wanting to invest, I suppose ultimately it's sort of, in a sense, stating the obvious. Brutally, we need delivery from companies. So I think from your perspective, I'd like to think that you have to appreciate that there's huge information asymmetry. You live your lives in your companies, and we typically get an hour to an hour and a half with you, once or twice a year. And in some, if we think about the situation where we might be meeting with a company for the first time, that information is asymmetry is even more marked. So I think it's clarity above all. And I think from a company's perspective, they probably have to sort of sit back and sort of look at the material that they may want to put in front of us and ask themselves the question, if I sat there and went through that, what messages would I actually come away with? And if I think back to the hundreds, probably thousands of meetings I've done over time, too many of them, I think, from my perspective, you come away with a sort of a pretty jumbled message. Maybe we are guilty of having too short an attention span. Meeting with a lot of companies, it's huge competition for our time, huge competition for our sort of thinking time as well. So the clearer that message, the better the outcome in all likelihood. And then I suppose, ultimately, the other key thing is really, I think, building up trust. And again, it's a cliche, but it's nonetheless completely true. Under-promise, over-deliver. And if you do that consistently, clearly the likelihood of knowable information being appropriately reflected in the share price is going to be all the greater over time. And I suppose one practical element within that is, I think, to make sure that at any point in time you are conscious of where forecasts for a company are pitched, not just what is the bottom line number, but does the actual overall structure of those make sense? So someone on the board, most likely the FD, I think, has to be very clear on what forecasts are in the market, are they coherent, do you feel comfortable with them? So I hope that gives you a good sort of flavour for what we're thinking. I'll hand over to
Thanks,
another
Dan.
of the panel.
Leigh.
I think Dan's covered everything there. So, my name is Leigh Himsworth. I work for Fidelity. I manage Fidelity UK Opportunities Fund. I've invested in mid and small cap companies in the stock market for nearly 20 years now. Before that, or actually the more you go back, the worse it gets, because I was an accountant before that and did law at university, and I was born in Hull. So it doesn't get much worse than that, I don't think. I think very similarly to Dan, we do look for I suppose cheesily, try to get to small companies before other people do, find interesting ideas, and trying to find companies with some niche or technological advantage or some new idea that not necessarily everybody's thought of yet, but have the ability to bring that to market and make the most of it as well. And I think what we're looking for is effectively companies that can plan and tell you about that plan in incredible detail, hopefully, and have the structure to succeed as well. I think we can all be guilty of focusing on the minutiae of individual meetings and so forth, but I think what's crucial is that the company and the management team have the ability to focus on, first and foremost, running their own company day to day and concentrate on getting the best out of that, and then forming a plan to tell the rest of the world, tell the journalists, tell the investment market, tell the investors that specifically invest in the company. And I think also the plan needs to involve the evolution of investment as well. The type of person that's going to get involved in the very early stage is a very different type of investor that might be there in 2-3 years' time, or as the market grows. So it might be an evolution of the way that you speak to the three different people on this panel at different times as well. And I think also the evolution of the way we've interacted with companies has changed probably over the last 20 or 30 years. The way that I first went out and visited companies is very different to what I do today. And in fact, I have probably less contact with management teams than I did 20 years ago, on the basis that there's so much more information that's readily available. There's probably a few people in this audience that remember the old system of having to fill in a little box in the FT. You had to send that off, post it for 3 days or so, wait for the accounts to come back to you, and then you'd realise you filled in the wrong box. So the speed that you can get information is that much quicker, and so we can cover an awful lot more information and a lot more ground than we could in the past. So the meetings, the ability to cover more interesting detail in meetings is that much changed and evolved from the past. I think when I go and visit companies now, or vice versa, I try to have a combination of visiting people on their territory as well as in the city as much as possible. I try to get to the nub of what drives the company, what's interesting to management, why they see the opportunity at that particular company. and try to set the company in its position in the industry it's in, the competitive factors, why they think they've got an edge, and to try and get some flavour of how that pervades through the company as well, not just the very senior board teams, but also non-exec, second-tier management, how enthused, that even simple things like the receptionist and so forth, to get a feel for what's important for the company, and then continue that relationship going forward. I'm sure we'll get on to talking about individual news announcements like profit warnings and so forth, but it's that clarity that's very important, certainly to me, and that relationship and with the ongoing investors and how it evolves over time that's very important. I'll probably leave it for questions to pursue some of those.
Thanks, Leigh. Judith?
Well, you're going further north here from Hull, migrating up the country. But not are we different, only are we different in terms of geography and where we're from, but I think from our perspective, we'll probably never have the same amount of funds under management as my two erstwhile colleagues here, because we look at right at the bottom end of the market, probably what I call the dirty end. It's maybe not fair to say that, but we go right down the market cap scale because that's where we believe the value is. So we're hunting for market caps of under 50. We say under 150, but typically really under 50 is where we see the value. And that drives maybe a slightly different investment ethos and philosophy, and also investment style in terms of execution. Very, very bluntly, we're only looking for one thing, and that's a return on the investment that we make with you. And for me, that is driven through probably three different factors, or combination of different factors, and that's sustainable earnings progression, it's sustainable return on capital employed or invested capital, and that's driving free cash flow. So those are the kind of metrics that I like to get involved in. We don't really care about things like PE ratios and analyst forecasts. Probably shouldn't say that with Sam sitting here. But we're almost trying to apply a bit more of a private equity style to investing in what we regard as almost a private equity type company. So we do all our own forecasting. We then cross-reference it with what the market is saying, but we're trying to build our own intrinsic value of the company bottom up. So taking those cash flows, taking the quality of those earnings, taking the assets, literally going around kicking the tires and building our own net asset value. And that in its own way takes quite a lot of time. So we only invest in between 25 and 30 companies. We don't have a lot of turnover in our portfolio. We pretty much want to hold those companies until the day that we all die. Maybe die is not the right word, but until the day it gets sold out or there's some kind of catalyst. We like to take holdings that allow us to be a bit more strategic. So it's a bit of a disappointment to see that you all think that institutional shareholders aren't that strategic. We are trying to break the mold there. And therefore, we like companies and management teams that have got skin in the game, who have invested themselves as well. So you've got that shareholder alignment from day one. And very similarly to the other panel members here, we do all the usual diligence. We do like going out to see companies, not in our shiny suited office with a shiny suited presentation. We will spend time with the operational management team, get involved with the boards where we can introduce board members if appropriate. So it's a bit more hands-on. And again, just going back to the original point, is because of that hands-on and the focus on the micro-cap end of the market, that our funds will never be into the billions. We're in the hundreds of millions, but not really at the larger end of the scale. So it's a completely different, I suppose, we might be looking for something that's a little bit different to the other panel members here. And again, going back to what getting our attention is knowing your audience. So you might want to do a little bit of a different presentation to somebody like myself on site with a company, as opposed to meeting an institutional investor for the first time. So again, that's where your broker might or should be doing a bit of homework, so they know the requirements of the type of investor that you're getting in front of. What we don't like, we're not very good at IPOs. I don't think, I've been investing for 20 odd years in this space, and in the last 7 years I've not done one IPO. This time last year I was sitting there wondering what on earth I was doing, because I was missing out on everything that was going up by 40%. But I've got to say, we didn't really miss out net in terms of performance last year. And our process is far slower, as you can probably tell by the philosophy that I've just explained. We want to do our own forecasting, do it bottom up, be a stock picker, which means therefore that we're taking sometimes 8, 9, 10 months to make a decision. But my experience has shown in this area of the market, it actually doesn't really matter too much. You're not going to miss out on things. I'm not a very good momentum investor. I'm much more of a value investor. Again, it's about knowing your audience. We're not very good at investing in technology because we don't understand it. We're not very good in investing in holes in the ground, mineral extractions companies, because we're not geologists, we don't know what's coming out of it. We do like the attributes that I've talked about, free cash flow, return on capital, and going back to that management alignment. If a management team is sitting in front of me and they're being paid quite well for what they do, and they've not even bothered to invest 1 penny in the business, it does raise an eyebrow for me. So that shareholder alignment and the incentive element of corporate governance is something that we're quite hot on. And we like it small, where other fund managers have business models that mean that they can't necessarily invest in a £9 million market cap company. We're not scared of that, and again, that's where we're finding some of the value at the moment. I think that's it, actually. Wait for the questions.
Thank you, Judith. I think it might be worth just commenting and getting the panel's views on sort of market sentiment at the moment, where you think the view is on small cap investments and the availability of funds.
Okay.
Dan, do you want to
I'll kick off? Well, I suppose putting it into context first, 2014 was a relatively disappointing year for small caps. So they did underperform modestly over the course of that year. And I think there's been, certainly in the run-up to the general election, something of an element of risk aversion. So a lot of commentary, people saying they don't, our underlying investors saying, we just want to sort of hold fire, it's not an area we particularly want to get involved in. I think personally the election has been something of a watershed. So, without being overly party political, we're in a situation, I think, where we've got, a broadly business-friendly government with, a working majority, and that, I think, for markets, or certainly for the UK market, is an unequivocal positive. Valuations clearly are stretched relative to history. We look at PE multiples at least. The UK all share trading around 15.5 times on a 12-month forward basis. That compares to a sort of long-term average of about sort of 13. So we are trading at slightly elevated levels. But the UK economy is improving. Of all the major economies, I think we look pretty well set. We look as if we can grow at a trend type rate, certainly this year and probably for the next few years to come. So pulling all of that together, notwithstanding possibly sort of an element of stretch valuation relative to history, actually with the tailwind of an improving economy and with actually in the UK small cap space, and actually I take a slightly different view on the IPO front. I actually think it's been a pretty strong positive for the UK equity market, the fact that we've got companies coming back in. Because, again, sort of stepping back for a second, one of the things I didn't mention earlier is, my fundamental belief that even in the market cap or part of the market cap spectrum that I operate in, I think you genuinely do get pricing anomalies, relatively poorly understood companies. The more companies there are to invest in, the greater the likelihood, in my view, that some of them will be mispriced. So actually, the reopening of the IPO market, I would view as a pretty strong positive, both in the near term and over the longer term as well. So I'm pretty sort of positive on the market environment now. I think something has changed positively in terms of risk aversion. I think earnings growth should accelerate as we go forwards, and I don't think valuations, while higher relative to history or higher than average over time, they're not particularly stretched, particularly relative to other asset classes as well.
So would you look at IPOs?
Absolutely, yeah. I think we're discriminating, so to put it into context, if we think about the last year and a half, say, I would guess we probably looked at, in some shape or form, be it just desk work or actually meeting with companies, we probably looked at or appraised in some way 100, 120 opportunities, and we've done about 15 of them. So in the context of the portfolio, so I'm running around 85 positions in the portfolio, 15 of them are new via that route. So that's, I think that's quite an important number.
Leigh, what's your view of the market?
We're in danger of being a little bit too consensual here, so I'm going to have to say something controversial. But I think, firstly, market rating, let's cover that. I don't think the ratings are massively stretched, because I think if you look at where the oil share is, which is probably the best proxy for overall ratings, yield of just short of 4% with forecast earnings growth for this year in the realms of 1 or 2%. That takes your expected returns to bang in line with annuity rates, which means that the market is probably about right. It's neither massively cheap nor massively expensive, which means I think then for us as investors, we have to spend some time looking for interesting ideas. And I think for the mid and small area of the market, it's actually quite good news, perversely, that we've had problems in significant large sectors of the FTSE 100 in the last few years, banks, mining, and more recently oils, because it forces people to reassess their view of risk in the FTSE 100 and realise that it's still risky to invest in large cap companies as it is in mid and small cap companies. The risk comes when you don't do your work properly and when you don't do your own due diligence on certain companies, etc. It's as risky to invest in a BP in this world or a bank as it is a smaller company. Liquidity is the only significant different issue there. I think also we're all in a privileged position, being in the UK, as you might expect I'd say, being a UK investment manager, that the UK is a great place to invest. We've got decent accounting standards, good levels of corporate governance in contrast to many other countries. We have a stock market where you can get access to most industries and depth of industries as well, whether it's tech at one end. If you do like mining, there's strings of mining companies you can invest in, so there's a wide variety you can invest in. And the maturity of companies as well. We have some brand new companies at the IPO end through to companies that have been in existence for well over 100 years. So the breadth is a great starting point. The UK, I think, is always very guilty of being a little bit negative about itself, and I think the press are significantly to blame. We've got a string of very, very good companies at this very small end of the market, very innovative companies with some great entrepreneurs, and they just need our backing. I think that the press is very guilty of saying we don't make anything anymore, which is, in my view, is absolute nonsense. We make some great stuff. It just happens to be not necessarily with the household names. We've got some great tech companies, some great innovative companies that sell globally. I remember my days of auditing in the early 90s, late 1980s, where some of the stuff was still being produced on machinery that was from the previous century. Now we've got a string of engineering and aerospace companies that are genuinely the best in the world, and so we've got some great opportunity. And I think we find day to day there's some great companies present themselves to ourselves. So I've got a very positive outlook for the economy. I try to look for companies that are as immune as possible from the general economic outlook, that they've got their own little niche, etc. But clearly you can't totally remove the economic factors from their outlook. But yeah, I think having the election behind us now gets rid of some uncertainty. I suppose the one elephant in the room, if you like, is potential EU referendum that will cause uncertainty, and it will cause investment decisions to be put on hold, whether you like it or not. It will cause some hiatus. The sooner we can get through it, the better, in my view. But it's a good outlook.
Judith, are you as positive?
I'm always negative. I suppose I can answer it in two ways. One is I'd absolutely concur with the sentiment around the companies that we're looking at and investing in. They're absolutely groundbreaking, cracking companies that have, some of them, got a really good track record, established niche in their space, great margins, really, really good businesses. And if we look at our portfolio, around about 45% is in industrial, so people that make stuff. Imagine that in the UK. And they are great and profitable, and as I say, have got dominant market share positions. And in terms of our whip list, and we look at this quite closely, because if we've got a long gestation period, then we need to make sure that there's new companies coming through that will fill the boots of the ones that we might be exiting from, that might have reached our share price targets. And our whip list just now is as good as it's ever been. despite the last 3 years of relatively benign markets in microcap and small cap. So from a stock picking perspective, I'm really enthusiastic. I think it's one of the best periods that I've lived through the cycles. However, on some of the macro, and just bear in mind, I'm useless at forecasting macro and markets, but I do think there is a degree of, I do think we could all be doomed pretty quickly. There could be some bubbles that burst that I am worried about, and there's Europe, there's the US debt, there's all these things that have been lingering in the background that we've chosen to ignore for whatever reasons, and really sort of push to the background. And if I look at some of those macro elements, I do get quite nervous. So that's why when I'm looking at the companies, I'm trying to do a degree of sensitivity, but we're looking for resilience in the earnings of these companies. I quite like niche companies as well. So I'm not that positive necessarily on the market as a whole. And if we look, we do quite a lot of analysis in terms of market cap bands from 25, 0 to 25 to 50 to 75, going up in 25 million tranches up to 500. And what we see is the 150 to 500 range has gone up significantly in terms of 10-year historic multiples, now in 23 times earnings, which now that's generalizing across those market cap bands for all profitable companies. But that says to me, looking back, that that section of the market is quite heated. So again, that's why we'll switch into that when we can and when we need to, but that is driving us further down the market cap scale at the moment. When you get down to sub 50, then you're on single digit. You make a mistake there, it's not quite as painful if you're investing in something 23, 24 times earnings. So I think that segment of the market's got a little bit heated. But I think it's also for a good reason, and that's through good work like the QCA does in getting laws passed to say that you can invest in AIM stocks in ISAs, which has actually pushed quite a bit of money into the market, which is a great thing. And I think the awareness of small cap and micro cap in general has increased over the last few years, which again is a good thing. So these things are cyclical. We all live through them and get on with it afterwards.
So when a company is coming to see you, obviously presentation is quite key. What are some of the do's and don'ts that you would advise to some of the corporates here? Do you want to start, Judith?
I've got a bit of a bugbear when you're going through a presentation and you ask a question and they say, no, that's on slide 29, appendix C, we'll come to that. And my memory is not very good as it is, so how on earth am I going to remember when I've got slide 29, appendix C? So I would just be prepared to go off the route map a little bit. And I think very much so with the other panel members, we tend to go, I shouldn't say this because there'll be some company in the room that says I wasn't prepared, but we tend to have done quite a bit of work before a meeting. We like to use the meeting not as a kind of flick the pages on a presentation, but actually to try and get to know the company a bit better, and that means going off the route map a little bit. So deliver the message succinctly, just going back to the key points here actually, succinctly in a simple way. Don't give me 10 slides on macro because I read the FT, so you don't need to tell me necessarily about what's happening in the world. Just tell me about how you make money, literally taking the pound that I give you or you take from the market and how you push it out the other end and make that return on capital. Make it really simple for us and be prepared to literally tell us the story and go off the route map if you need to. So yeah, sticking to that rigid presentation is a killer for me.
Leigh, any top tips?
I would absolutely agree with that. I prefer it when the slides are used as just a backup to support what the management team is saying, and I much prefer it if a management team can just talk enthusiastically about their opportunity. And what I like to see is that it becomes evident through the meeting that they understand the industry that they sit in, they understand their opportunity within it, and how they're going to take advantage of that in terms of the structure of the business, the capacity, etc. And if we're getting into the detail about numbers, yes, I would absolutely echo the fact that we've probably done an awful lot of the number work before the meeting. But what I want to see is that the company can put the numbers into context, so you can talk about cash cycles, you can talk about the overall enterprise value, the way that the company is financed, the appropriateness of the finance within the business, any future needs for refinancing in terms of capacity developments and growth of product set, etc. And then also the development of a product set or geographic set of a business. So I can see clearly what the intention is of the business over the next 5 years, and so it gives me a benchmark to look at as to success or failure over that period. So it's that clarity and where the companies sit that's very important to understand in the meetings.
Dan?
I'd probably just add a couple of things to that. I mean, just picking up on one of Judith's points. We don't necessarily invest on the basis of a first meeting. And increasingly, just with the onus of greater, tighter regulation on us, our minutes taking, our note sort of collection, our scrutiny of previous meetings is getting all the more intense. So I think what flows from that is just a sense of, if we can see a story, a narrative that's consistent from one meeting to the next, then that's going to engender significantly greater confidence on our part, and I think will probably lead, more naturally to not just investment, but hopefully investment with conviction as well. So that clearly would be, an element for me. And I think, alongside that, in terms of don'ts, management teams that are too focused on the share price. That is a very sort of significant turn-off, I'm afraid. Concentrate on running your business, delivering what you say you're going to do, and hopefully more, and everything else will take care of itself. But management teams that come in and whine about the share price without actually appreciating that they're not really either delivering or explaining the business model, the investment case clearly to the city in the first place, that's something to be avoided.
So how long might it take a company to get to know you before you might make an investment decision?
Well, there's no single answer to that, and I think ultimately it's a case of pragmatism, I think, on our part. And again, there's no single answer. What we might typically do would be to say, look, from our perspective, we can see that there is a potentially very interesting investment case unfolding here, but actually, do we in our heart of hearts believe that we fully understand it? No. So what we might do is to say, well, look, we will take an element of exposure now with the hope that over time we understand the investment case better and we can actually be more aggressive in how we invest in any given company. So we don't necessarily sort of move to a maximum position size at the outset.
I think it depends on the company as well.
Yeah.
The sort of person that you're meeting. There's certain companies that you can be up to speed very quickly if you've got similar investments or exposure to similar industries already. But if it's something totally new, like, I don't know, a new mining company or biotech company, then clearly your ability to get up to speed on what that company's aiming to do is that much longer than on maybe a food retailer or something. So it varies massively in terms of the sort of company that you're presented with and the stage of development. I think what's also important is to, if you're going to invest in a company, is establish a rapport with management. What does the management expect of us as well is important. Can we give any sort of assistance in terms of corporate governance or new angles or exposure to other ideas and so forth? So I think in part it's a two-way relationship, but particularly at Fidelity we do have departments that do work on the corporate governance side, working with companies to try and assist and lead companies. So it can be, it's not just all one way, it's not all just us grilling you like Dragon's Den or something, it's two-way.
It's interesting. I think the question at the beginning was, do investors add value? And there was a bit of an unsure answer.
Yeah.
I mean, how do you think you add value to companies you're investing in?
Thanks for that.
Judith, you must get quite involved in
Well,
a lot of your corporates.
the best reference is probably the companies that we've invested in. We've got a portion of our portfolio, say 10 out of the 30 holdings that we have, that are quite strategic, where we've taken plus 10% of the companies, and we are acting more like partners. We like to think we are, probably not. And where in, I would say, all of those cases, we've either introduced a non-exec, introduced a chief exec, introduced an FD. We're not imposing, but Downing's now relatively big. We've got over 250 companies within our public and private equity portfolio. Not so much the public side, but we can find a man that knows something within that private equity background as well. So we like to think we can nudge in the right direction. We're, as I say, absolutely not saying this is our man or woman and you've got to take them. It's more collegiate than that. We don't need to get involved in activist situations. Or things that need necessarily turned around. but we're not scared of standing up and saying that somebody's maybe not fit for purpose if that's the case. So we've cornerstone fundraisings where good folk like yourself take as an opportunity that you know that might fit our criteria, and we would cornerstone and spend time putting the deal together with you to cornerstone an acquisition of something. So we like to think we're more strategic, but who really knows? As I say, the reference point is the companies that we invest in. It certainly has paid off in terms of returns. The return from that type of strategic investment that we've made has been exceptionally good over the longer term. That's over a 5-6 year period now, and they are exponential compared to what we'd get in our sort of more mainstream value part of the portfolio. So we know it works.
Yeah, Leigh?
I think it's important to remember that it's not an adversarial meeting. We want the companies to succeed as well as management, so it's not something that's designed to be critical or anything. Any discussion that you might have is designed to be helpful as much as is possible, and building on experience from either internal departments or we might have our own personal experience.
Dan, any thoughts?
Well, I suppose, a general one more than a specific one, but it's just interesting from the evolution of our business. If I think back, to the beginnings of the 2000s, we were, in the UK at least, effectively a sort of boutique operation, and we had limited, manpower to do the sort of company engagement at that stage. And frankly, our approach was, I think, typically then, not really holding that much of a given company, and we felt that something wasn't working out. Our approach was typically to sell and move on. Things, not just in our business, but I think at an industry level, are changing. So a couple of years ago, we took on for the first time a head of risk and governance and stewardship, I beg your pardon, whose very brief is very much to do that sort of work, to make sure that any sort of AGM, EGM, any sort of voting is properly scrutinised, and that we do have a channel for engaging either with the board or with the chairman when we think that actually some sort of greater intervention is required. So I suppose what that distills down to is kind of sorry for maybe how we might have been in the past, but I think we are changing. We're trying to, in a very genuine way, have that sort of stewardship element to our work as well now.
Okay. I think the other thing we wanted to talk about was obviously in smaller company world, not everything goes according to plan, and there are downgrades and profit warnings and surprises. Is there any advice you would give in terms of how to manage bad news?
Shall I start?
Yeah, you start.
Again, I sense I'm going to say the blindingly obvious here, but I think the worst of all approaches when you're in that situation is to be anything less than totally candid. So when there's bad news to disseminate, make sure that you do it to the fullest extent and enable us, again, this information asymmetry sort of thought, but enable us to understand in the greatest possible detail what the issues are, what the remedial action is, and enable us to sort of to understand the problem. Allowing bad news to leak out over time, it just is, I think, catastrophic for, a company's rating as much as anything. So, just be candid.
And if there is some bad news, when would you expect a call from the management?
Well, in very simple terms, the earlier the possible, earlier the better. Again, allowing things to fester, clearly, is again hugely damaging, and I think can lead quite genuinely to recrimination if it became apparent at a later stage that negative news had been known sometime before it was disclosed. That I think is again the worst of all worlds. So make sure that you're timely with your dissemination of bad news when you have it.
Leigh?
Yeah, I think there's a lot in a question like this, because I think it's very easy to just latch onto the actual news flow, the profit warning or negative news, but I think you need to step back and say actually there's a lot more that companies can do to actually stop bad news ever happening in the first place, which is, one, be patient, and it goes back to Dan's earlier point of don't focus too much on your own share price, because there's a chance that you'll do something that you might regret later in terms of an action that you might take. So be patient, plan, and manage the news flow very well in terms of many of the warnings that you see can be avoided in terms of the severity through just good relationships with the city in terms of managing news flow, saying perhaps things aren't going slightly as you might expect, and just manage the earnings expectations downwards slightly rather than it coming in a thumping blow late one Friday afternoon that we've all seen, those sorts of things. So managing the news flow is very important, managing the relationships is important, and planning. But then when there is that negative blow or the side swipe from something unexpected, I would agree wholeheartedly, be as open as possible, quantify as quickly as possible, and then also get on the front foot and plan as to how you're going to redress the situation, and so take a positive view from it rather than just dwelling on the negative of whatever the news flow or issue is particularly. So you can try and get out, and rather than it being a profit warning, it becomes something a little bit less dramatic in terms of the description.
Judith, anything to?
Yeah, I think it's worth remembering that we as investors understand that sometimes the binary nature of your reporting periods, where there's a knife coming down at the end of the month of the year, that there might be a contract that falls into the next period. That's completely different to something that obviously the absolute other end of the spectrum, where there's fraud or kind of the worst case scenario. So you've got to understand that profits timing and contract timing, and sometimes even a loss of a contract, is something that if we understand the business, we should be able to understand and consume that information pretty quickly and help quantify it. But just going back to what's been said, just be clear, try and quantify, make it concise, well not even concise, but almost give us quite a lot of information if you can, to quantify what the downside is, how you've mitigated it, and do it as early as possible. Even sort of, if you can, phoning up investors after 4:30 or key investors after 4:30 the night before, or 7:30 the next morning. We're all used to that one, sadly. We always know what's happening when a broker phones you at 7:30 or 7:15. So don't shy away from it. And at the other, I won't talk about the other end of the spectrum because we try to ignore the really bad, horrible things that do happen. But even there, you're hoping for, if it is a real doomsday scenario where there's fraud, goodness knows what else, and somebody's had their hand in the till, then you're hoping that the chairman or somebody on the board has stepped in and is giving you quantifying, giving you a plan of action, and giving us as shareholders the full kind of risk mitigation package on the day that it's announced. We don't have many of them, by the way, hopefully.
Excellent. Well, I think it's probably time to open it up to questions. Do you want to do this?
Thank you. I'm Susanna Oliver. Let's say that I'm, a relatively small company that you may not have heard of, and I'd like to present our case to you, and you're really busy people. How do you decide whether or not to see a company that is new to you? How do you like to be approached? And how can I, as a company, maximize my chances that you will, in fact, accept a meeting with me? Thank you.
Who else go first? Dan?
Yeah, well, I think in practical terms, and it's partly coloured by, the market cap spectrum that we operate in. We're that bit further up the market cap spectrum. I tend not to like to be approached by the company themselves. It's easier, I think, for us to actually work through or work with the sell side to make the initial introduction. And again, slight contrast to what Judith said, it helps if there is some analysis out there of some quality to enable us to actually at least understand the basics of the investment case before we start. From a time allocation point of view, it's very difficult to say, look, there's no real information out there, but look, trust me, spare me a couple of hours and I'll talk you through the story. It's not typically what we do. So it does help if there's been a really good engagement with an advisor, with a broker, to actually sort of preparatory work be done to help us get at least part way along the curve.
Leigh?
Yeah, I think there's a number of things in addition to that. Yeah, again, echoing a few things. But from your side of the equation, I think it's, if you think that people are missing the story, then I think it's right, one, to engage with an appropriate level broker for your stage of development. Pick someone that will try to match the right investors with the size of company. So there's no point getting a broker like Goldman Sachs on day one, because the mismatch of investors is crazy. But get an appropriate sized broker for the stage, and that will evolve as well. So what might have been appropriate at 20 million market cap is very different at 200 or 300, etc. million. And then also at the small end of the spectrum, there are the PR agencies, I forget the term, but the people like Broker Profile that do work as well to try and engage people, investors around the country, set up investor meetings as well, so you can cover appropriate level investors as well through that means. And then I think it's just a question, in addition to all of that, is just continue to generate the returns yourself, and you will get noticed. You know, we've got strings of analysts that are looking out for companies all the time, and the more that you do your stuff, the more that you will get noticed and you will get the coverage. So again, it is back to the point of being patient, but plan properly, the right brokers, right advice in the first instance, and probably the right accountants as well.
Judith?
Yeah, not too much to add to that, really. It's quite difficult for fund managers like us that don't necessarily, we do a lot of our own screening and our own origination, and that is literally just being pretty boring and sitting down with spreadsheets. So if we see continuity of earnings, return on capital, and free cash flow and all that stuff, then you will automatically come up on our radar. We do, from a select number of brokers, you guys included, if there are companies that they feel are interesting and suit our criteria, then we will have an ad hoc meeting after we've done some desk work, and that desk work will literally be reading maybe the last couple of years' report and accounts, because they, to us, are the purest form of information that we can get about a company. So I think it's about the advisor, just reiterating what the panel's saying. Quality of advisor and relevance of advisor for your stage and type of company really is quite important, because that really is the medium to people like ourselves, especially as you go up the market cap scale.
Next question. I see. Tim.
Hi, could I just ask about the circumstances in which you're happy to become insiders when there's a deal or something like that on, and what happens when you inadvertently find yourself on the wrong side of the line?
Leigh, do you want to start?
Yeah, I don't mind taking that. We actually have a system it's pretty rigorous now for going inside on any information, not just inside, but also fundraisings and so forth that might be in the pipeline. It's all centrally dealt, so no one individual takes the information themselves. It's allocated to the relevant people in the appropriate manner and correct timescales. But taking the example, if you inadvertently come across something perhaps on a visit or meetings or maybe in a social environment as well, which is quite possible, then we do have immediate response. And if I come across something now, then I'm expected to get in contact immediately with our relevant compliance departments and flag it and put it on the relevant stop lists, etc. So it's fairly, it's pretty rigorous and hopefully fail-safe as well to put the relevant stops on dealing in anything or preventing any misuse of information. I suppose it's the misuse that's the important thing. We'll all probably come across some information. It's just making sure that doesn't get misinterpreted or misused in some way.
And Dan, Old Mutual?
Yeah, I mean, I think clearly regulatory standards are tightening all the time, and I think there are two real sort of strands to this. Fundraisings, these sorts of things, it's very clear. There's a very sort of formulaic sort of means by which information is disseminated and recorded, and who is inside for how long, why, and when. The issue really comes when I think management teams say something in a sort of closed meeting, which we feel uncomfortable with. So, bluntly, don't say anything in a closed meeting, which the whole world doesn't know. This whole selective briefing idea is a big no-no now. We just don't want to know. I do not want to be, nor do any of our sort of team colleagues want to be compromised by feeling that we know something that is not generally known.
So courts need to be a bit careful about what they say and how they present.
Absolutely. It's not like the good old days. It is, I think, a very, very tightly policed world now, and the risk to our lives and frankly liberty is so great that we just don't want to be put in that position.
Yeah. Judith, presume the same for you?
Yeah, no, absolutely the same thing. And I think the broking community, corporate finance community, has got far sharper, and quite rightly so, in policing meetings and making sure that the things aren't said inappropriately. We like to, maybe slightly different to some other larger houses who have lots of bells and whistles. We just got bells and whistles, well actually probably quite a lot of them as well. But we like to be brought inside if there's a transaction quite early on, but it's to do with our investment process as much as anything else. If you came to us, even a company that we might have a holding in already, if you came to us and said that there's a fundraising and you're closing it tomorrow afternoon, that just gives me a heart attack. Because we want to be able to do a little bit of work round about it. We want to maybe spend 2 or 3 days doing some outside referencing and asking questions of the management team. So we like to be brought in transactions, we like to be brought over the wall, probably 2 or 3 days, or as soon as possible, as soon as the company's ready to go.
Okay, excellent. Any more questions?
Could I just seek a bit more clarity on becoming an insider with regard to a fundraise for an acquisition? Because typically it used to be 2 weeks, which was considered acceptable. So in a fundraise for an acquisition, what period of time are you prepared to be insiders?
Well, I would be inside for as long as it could, the 2-week period, which tends to be the guidance, really, isn't it?
I think it depends on individuals. I prefer it quite a bit shorter because I do try to repeat to myself that my main responsibility is to the underlying unit holders. So I don't want to lock up their investment any longer than is absolutely necessary and restrict the fund in any way. But clearly you've got to have an ability of time to work on whatever the particular deal is, particularly if it's complex in any way. But again, the range of fundraising can be very short term, just raising a modest amount of money, to vast
or simple,
life changing for the company, which is a very different beast in terms of the ability to work. So there's no simple answer again, sadly, but it depends on the nature of the transaction and the scale of it, as well as to how long and what work is needed.
But say it was a big transaction, what I'm purposely pushing you to try and get some clarity here.
Well, you'd hope that the company have done an awful lot of work first, so it becomes relatively easy to grasp, and it does tie in with what you're expecting from the company. If it's something totally out of the blue that's unexpected and out of character, then I think you'd be a little bit sceptical in the discussion. So it's a difficult question to answer, I'm afraid. I wanted to try and avoid.
From our perspective, I think we would feel uncomfortable, I think, being an insider in that situation for more than about a week.
Okay, thank you.
I would say from a broker's point of view, that's fairly normal, but there is quite a broad range of, some people will want to know early on so they can do work, and some people won't want to know till even a couple of days before because of their compliance rules. So I'd say a week is probably around average, but it does vary, and the broker should be able to guide you how each institution will want to work. Any other questions?
Judith, I think you mentioned that you hold your investments for until you die, but the fund management industry has been renowned for churning its investments for quite a long time. Can the panel give us some views as to what their own individual houses are, policies are on churn, or what their actions are on churn?
Obviously, I've never used the word churn before in my life. It's a good question, and I think you'll get very different. Well, actually, you're sitting with 3 people that have a similar focus. There's not significant hedge fund exposure up here, which is probably a very different beast in terms of the underlying structure. And you've got certainly I know Dan's house and ours, and I'm sure speak for all three of us, in that we're all fairly longer term investors and looking for success over a sustained period. Now, to tie us down to a specific time period is probably the wrong answer. What we really should be answering is tied down to a specific return that we're looking for. That's ultimately what we're trying to achieve, is a return in excess of the alternatives that the investor could have, which probably mathematically works out at being 3 to 5 years, I would suggest, or perhaps even longer in smaller companies. But the question is asking each individual fund manager what's the level of turnover in your fund, and I would suggest that anything sub 200% is probably about right for a long-only investment manager. Anywhere between sort of 20% and 200%. Anything above that is probably excessive, and that's where the matching of investors probably comes in as well. Although you probably need a blend of investors within the fund, within a company, because that provides the liquidity, the ability to deal, and the free float of the shares. So you don't want to totally exclude some of that element of the investment community, but you don't want all of them.
Yeah.
Either.
No, I mean, we're clearly aware of it, but at the end of the day, people invest in the funds for a specific reason. So, we're trying to beat our competitors. We're trying to outperform our indices. Turnover, certainly in our funds, is the smaller company side is about 60%. So 30% in, 30% out over a 12-month period, which I personally wouldn't regard as particularly high at all.
Yeah, good luck trying to churn some of my companies with the share. So that's why we've got a slightly different diligence approach to making. Well, try not to make mistakes. Touch wood, touch something. I would say our typical portfolio turnover would be 10%, 5% in, 5% out. Saying that, last year we had a couple of trade exits that we'd facilitated, and a few things reached our intrinsic value, so we ended up selling out, and it was more like 2020, so 40%. So it's difficult to be prescriptive, but yeah, the bid offer spreads in some of our stuff is, our 25, 30 odd companies are so wide that we're not really there to be punters, and we're not very good at being punters either, so not for us.
So I think we've got time for one last question. I think Peter had his hand up.
Just as a sort of generic, are you seeing fund inflows as a sector as opposed to the other asset classes, and corporate action, is that more prevalent in the last 12 months or so? Thank you.
Yes, again, we're slightly different because we also have tax-driven products. I think I talked about the NISA or ISA and or PEPs, as probably most of the people in this room remember, where you can put an AIM stock into an ISA now, which is quite a nice tax benefit for individuals, and you also get inheritance tax reliefs on that. So we've seen inflows coming from that sector or subsector of the market, which is good. Our IHT business generally has improved over the last 2 to 3 years, and even for a more generalist microcap focus. So for us, net inflows, but it's as I say, we're always going to be the little tiddlers compared to the other big boys sitting next to me, but certainly net inflows, and it's heading in the right direction. Leigh?
Yeah, it's quite a big question. Yes, we are, and it's more specifically into the UK and UK small cap as well, which is probably more relevant. And I think as well, some of the changes to encourage investment are good news. Obviously, expanding the remit for AIM stocks, the ability to put more into an ISA, the pension changes as well, which are massively significant for the discussion. The overall wealth of a person is very important for advice and so forth. And so yeah, it's a good outlook, and it's currently good at the moment, good flows.
I personally, I think the experience has been slightly different. So certainly the industry data that I've seen says that over the course of the last 12 months or so, there's been something like 1.5 billion taken out of smaller companies' funds. From our own personal experience, if we think about 2014, it was a neutral year with a good set of inflows in the first half and then outflows in the second. Over the course of 2015 to date, again, a sort of pre- and post-election watershed. So quite persistent, small, but persistent outflows pre-election, which have turned the other way post-election. Hopefully, again, touch wood, that will persist. But it's been a fairly sort of mixed picture.
Thanks, then. All right, well, I think we have to wrap up. Thank you, Judith, Leigh and Dan.
Thank you.
I hope everyone found that interesting.